Hello everyone. I'll be continuing with chapter 2, tangible non-current assets. So let's begin with the topic of government grants. IAS 20 for government grants and disclosure of government assistance. Government grants often provide money or incentives to companies to export their goods or to promote local employment. Now, governments usually provide incentives to companies. Now, that can be in the form of either revenue grants or capital grants. Revenue grants are for generating revenue, as the name suggests. It is those are the grants which are provided, which help the company in producing more goods in order to get more sales. Like for example, contribution towards payroll costs. Whereas capital grants are the grants which are provided for mostly purchase of fixed assets and non-current assets. Okay, so these are the two types of government grants. Principles. IAS 20 follows two general principles when determining the treatment of grants: prudence concept and accruals concept. As we have also studied these two concepts before. Prudence concepts: grant should not be recognized until the conditions for receipt have been complied with and there's a reasonable assurance that the grant will be received. Prudence concept in general means that we need to be conservative. So in context of government grants, it means that we should not recognize the grant until, because the government would not provide the grant just like that. It would obviously have certain conditions attached to it, that once conditions are fulfilled, the grant will be provided. So the grants should be recognized only when the conditions for received have been complied with. So only if the business has fulfilled those conditions as laid by the government, the grant is eligible to be recognized in the books. And there should be a reasonable assurance that the grant will be received. There should be certain confidence that the government would be providing the grant when the conditions have been complied with. Only then the grant can be recognized in the books. And accruals concept says that grant should be matched with expenditure towards which they are intended to contribute. So this is like matching concept, that the income that you receive, grants is a form of income. So the income that you received from the government in the form of grant, that should match with its associated expenses. The grant should be used to incur the expenses allowed by the government only. It cannot be used for any purpose. So it says that grant should be matched with expenditure towards which they were intended to contribute. These are the definitions, but it's not something that is important. Revenue grant. The recognition of grant will depend upon the circumstances. If the grant is paid when evidence is produced that certain expenditure has been incurred, the grant should be matched with that expenditure. If the grant is paid on a different basis, example achievement of non-financial objectives such as creation of a specified number of jobs, the grant should be matched with the identifiable cost of achieving that objective. In short, these 2 points basically mean that uh, if the grant is paid when evidence is produced that certain expenditure has been incurred, the grant should be matched with that expenditure. It pretty much means the same point which was discussed here, that the the grant money which has been received should be matched with its associated expenditure. So the conditions with which the government gave the grant, that it should be that it should be used for so and so expenditure only when that expenditure is incurred, the grant can be recorded in the books. Next, presentation of revenue grants. So there are two methods. IS 20 allows grants to be allows such grants to either be presented as credit in the statement of profit and loss or deducted from the related expense. So government grants are a form of income, so you can either record it on the income side in P&L, or you can deduct it directly from the expenditure for which the grant was been provided for. Let's look at this example. An entity is given 300,000 on 1st Jan 20x1 to keep staff employed within a deprived area. The entity must not make redundancies for the next 3 years or the grant will need to be repaid. By 31st December 20x1, no redundancy have been taken place and none are planned. So on Jan 1, the condition was that no redundancy must be taken place for next 3 years. So on 31st December, no redundancy had been taken. So 1 year has crossed successfully. Now, the grant should be released over the 3 years, meaning that 100,000 is taken to statement of profit and loss each year. Because 300,000 was given and the condition is that there should be no redundancies for 3 years. So 300,000 for 3 years, meaning 100,000 each year, as it's mentioned here. This can be shown as a separate line in the statement of profit and loss or deducted from administrative purposes. As 100,000 has been released to the statement of profit and loss, the remaining 200,000 will be held in deferred income to be recognized over the next 2 years. Of this, 100,000 will be released within the next year, so will be held within current liabilities. Remaining 100,000 will be held as non-current liability. So basically what this means that, firstly, this point says this can be shown as a separate line item in P&L or deducted from admin expenses or wherever the staff costs are charged. So as mentioned here, the revenue grants can be recorded in two ways. Either you show it in P&L as income, as mentioned here, it can be shown as separate line item in P&L, or you deduct it from that relevant expense. So you deduct it from admin costs, from admin expenses for this scenario. So 100,000 has been released to P&L. The remaining 200 will be held in deferred income because the next 300,000 is for 3 years. 100,000 is for current year. So 200,000 will be for the next 2 years. So it cannot be recognized in one go. So 200,000 will be held in deferred income. And in that deferred income also, you will segregate that between current and non-current liabilities, because of that 200,000, 100,000 will be incurred next year again, and the remaining 100,000 will be incurred at the end of 2 years. So out of 300,000, first 100,000 has been recorded in P&L on the income statement for the current year. From the remainder of the remainder 200,000, 100,000 will be recorded in current liabilities and the remaining 100,000 will be recorded in non-current liabilities. So this is all about revenue grant. In short, revenue grants are the grants provided by the government for for obviously generating revenue or any expenses associated with revenue, like for example payroll costs. Revenue grants can be recorded in two ways. First, as an income statement item in the P&L, or you can deduct it directly from the relevant expense. Also, revenue grants can only be recognized when the conditions have been fulfilled and the income received from the government should be matched with its associated expenditure only. This condition also applies for capital grants as well. Now, capital grants. IAS 20 permits two treatments. Again, there are two treatments for capital grants as well. Remember, capital grants was for purchase of non-current assets. You can write off the grant against the cost of the non-current asset and depreciate the reduced cost. So, suppose the cost of the asset is 500,000 and you got a grant of 200,000. So that means you charge depreciation only on the 300,000. Next is that treat the grant as deferred credit and transfer a portion to revenue each year, so offsetting the higher depreciation charge on the original cost. This will better be understood with the example that we will do below. But this basically means that the 200,000 that has been received, you record it as deferred income, and each year transfer a portion of that to revenue to statement of profit and loss, and that should be equivalent to the depreciation charge. Let's understand this better with this example. So, capital grants: an entity opens a new factory and receives a government grant of 15,000 in respect of capital equipment costing 100,000. Though it depreciates all plant and machinery at 20% per annum straight line. Show the statement of profit and loss and statement of financial position extracts in respect of the government grant in first year under both methods. Now, let's do it first as per method 1, which is method 1 says that you deduct the government grant from the cost of the asset and charge depreciation on the reduced value. So let's first calculate the depreciation itself. So the depreciation would be, so okay, wait, let's do it like this. So cost of the asset is 100,000, grant is 15,000, difference is 85,000. So the depreciation will be charged on this reduced value of 85,000. So 85,000 multiplied by 20% because it's straight line, this would be 17,000. So 17,000 is a depreciation cost. So in P&L, you would mention depreciation of 17,000, and in statement of financial position you would mention non-current assets. Non-current assets would be 85,000 minus 17,000. So this would equal to 68,000. Remember, in non-current assets, you won't deduct 17,000 from the 100,000. You would deduct it from the difference value. So 85,000 from that 17,000 would be deducted, which would amount to 68,000. So this is how it's being done as per method 1. Let's do it as per method 2. So as per method 2, the grant income received is 15,000. So grant received is 15,000. Alright. Now from this 15,000, we have to transfer certain portion to profit and loss. See, treat the grant as deferred credit and transfer a portion to revenue each year, so offsetting the higher depreciation charge on the original cost. So you would transfer a portion. Okay, we would transfer a portion to P&L. Now that value, what amount would you transfer? That amount would be depreciation charge. So the depreciation charge is 15,000 multiplied by 20%, amounting to 3,000. So let me explain. Grant received is 15,000, and the method says that recognize the grant initially as deferred income and transfer a portion to revenue each year, so offsetting the higher depreciation charge based on the original cost. If we had followed it normally, the higher depreciation charge would have been 17,000, because based on the original cost, the depreciation charge came to 17,000. But since we are following the second method, we are offsetting it based on the government grants. So we are offsetting based on the government grant. So we are calculating the depreciation on the government grant. So 15,000, 20% of 15,000 is 3,000, and this would be transferred to profit and loss. So the remaining balance of grant would be 15,000 minus 3,000, which would be 12,000. Alright. Now, this is the remaining grant for the current year. Now, from this 12,000 would be divided into current and non-current liabilities, because a portion of it would be used for next year and the remainder would be non-current, that is it would be used after 1 year. So 12,000 would be divided into current liability and non-current liability. The current liability portion would be again the depreciation charge for the next year, because again you would have to, again next year also you would have to transfer 3,000 to PNL. So the current liability part would be 3,000 and the non-current liability part would be the remainder amount, which is 12,000 minus 3,000, which is 9,000. Alright, so this is about the grant part. Now um let's see what, so let's summarize what is recorded in PNL. So in SOPL you would obviously record depreciation. Depreciation here would be on the original value, that is 100,000 into 20%, because in SOPL we are recording depreciation for the year, we are offsetting the grant, that is a method which can be followed. But in SOPL you would record the original depreciation that was incurred, so which is 100,000 multiplied by 20%, this would come to 20,000. Okay, and we transferred a portion to PNL of 3,000. So because it's an expense, this would be in negative, and we're transferring a portion to PNL. So or this would be government grant 3,000, that is what we calculated here. We transferred a portion to PNL of 3,000. In SOFP we would record non-current asset. Now similarly for non-current asset also we would record the original cost minus the depreciation, so that would be 100,000 minus 20,000, this would come to 80,000. All right, and then this is the liability part. So let's summarize this whole question again. So method 1 is pretty straightforward. In method 1 we first see what is the cost of the asset, the grant which is received. We calculate the difference value and charge depreciation on that difference value itself. So in method 1 that is how it's done. And in method 1 we charge depreciation on the reduced value itself of 17,000. And in SOFP we calculate the value on reduced value minus the depreciation, and the remainder is been recorded in SOFP. Whereas method 2 it's different. So in method 1 all the calculations have been done on the reduced value or the difference value. Alright, but in method 2 it's different. In method 2 the grant received is 15,000. We will transfer a portion of that grant to PNL every year, and that portion, how will you calculate that? That is calculated as depreciation percentage multiplied by the grant income. So which is 20% multiplied by 15,000, which is 3,000. So 3,000 will be transferred to profit and loss every year. So for that, for the current year we received a grant of 15,000, transferred 3,000 to PNL, so remaining value was 12,000. Now this 12,000 is the remaining grant value, and remember that we are in method 2 grant has been recorded as deferred income, that is it's a liability. Now this 12,000 is a liability, but liability will have to divide it between current and non-current liability. The current liability portion would be what amount of it will be used within the next 12 months. So within the next 12 months again we would have to transfer a portion of the grant in the PNL, and that portion would again be the depreciation value. So that means again 3,000 would be transferred next year to PNL, which means that out of the 12,000 balancing figure, 3,000 would be current liability because it will be used next year itself within 12 months, and then the remainder 9,000 would be non-current liability. Okay, now um, so 12,000 is divided between current and non-current. In SOPL, we would record the depreciation and government grant. In now depreciation, the recording of depreciation in method 2 is different from method 1. In method 2, we would record it on the original assets value of 100,000. Whereas in method 1, if you remember, it was calculated on the difference value. That is 85,000 multiplied by 20%. On the difference value, depreciation was calculated. But in method 2, we calculated on the original amount. That is 100,000 into 20%, giving 20,000. Then the portion that we transferred to PNL, that is 3,000. So this would be recorded on the credit side. In SOFP as well, we would calculate the value using the original assets value. That is 100,000 minus 20,000. Whereas in method 1, we had calculated it based on the difference value. That is 85,000 minus 17,000. So this is the difference. So just remember that in method 1, calculation is performed on difference value. But in method 2, calculation is performed on original value. So this is all about revenue and capital grants. Now, repayment of grant. See, in certain conditions, in certain circumstances, if the business is not complying with the conditions laid down by the government in order to receive the grant, then in those conditions, it may be that the business may need to repay the grant. So in some cases, grants may need to be repaid if the conditions of the grant are breached. If there's an obligation to repay the grant and the repayment is probable, then it should be provided for in accordance with the requirements of IAS 37. There's a whole chapter on this, so we'll see it later on. But if it is probable and you have an obligation, then you have to record it as per IAS 37. Next topic is IAS 23 borrowing costs. IAS 23 borrowing costs regulates the extent to which entities are allowed to capitalize borrowing costs incurred on money borrowed to finance the acquisition of certain assets. Now, sometimes to acquire certain assets, companies take a loan, right? That is, they borrow finance in order to purchase those assets. So the interest which is incurred on that can be capitalized for certain assets. That is known as borrowing cost. So borrowing cost must be capitalized as part of the cost of an asset if that asset is a qualifying asset, one which necessarily takes a substantial period of time to get ready for its intended use or sale. Okay, so qualifying asset is basically an asset where it takes a reasonable amount of time to make that asset ready for use. It should take a certain substantial period of time to get it ready for whatever the intention was for that asset. Now, commencement of capitalization. That is, when should you start capitalizing the borrowing cost? IAS 23 states that capitalizing a borrowing cost should commence when all of the following conditions are met. Expenditure for the asset is being incurred, borrowing costs are being incurred, and the activities that are necessary to prepare the asset for its intended use or sale are in progress. So only when all of these three conditions are fulfilled, borrowing costs can be capitalized. So the condition is that expenditure for the asset is being incurred. That is, certain expenditure has been incurred for the asset to get ready for its intended use. Second, borrowing costs are being incurred. That is, interest is being paid on that finance which has been borrowed. And third, whatever the activities are to get the asset for its intended use are in progress. For example, if it's about construction of a building, then whatever the activities are to get that construction done, maybe setting up bricks together, putting cement, or whatever the activities are involved, those are in progress, are not stagnant. That is when the capitalization begins. Now, the rate of interest to be taken. Where funds are borrowed specifically to acquire a qualifying asset, borrowing costs which may be capitalized are those actually incurred, less any investment income on the temporary investment of the borrowings during the capitalization period. So sometimes what happens is you have the borrowing costs which are there, certain part of it might be invested. So you have to take the difference value. Now this will better be understood by the example below. But the main point to remember as of now is that the capitalization, the borrowing cost can be capitalized only when these three conditions have been fulfilled. Only during that time, the cost can be capitalized as part of the cost of the asset. Otherwise, those will have to be expensed in P&L. Now, let's solve this question. Wilson received an 18 million 5% loan on 1st Jan 20x8 to finance construction of a new factory. As the funds were not all acquired immediately, Wilson invested 6 million in 2% bonds until 31st May 20x8. 31st May 20x8. Construction of the factory began on 1st March 20x8 and was completed on 31st December 20x8. Now, firstly, it's a construction of a new factory. So this is a qualifying asset because construction always is a qualifying asset. Any construction of any asset falls under to be qualifying asset because it takes a quite a substantial amount of time to get it done. Now, the question is that calculate the amount of interest to be capitalized in respect of the factory as at 31st December 20x8. Now, first, let's note down what is the construction period. Construction period is 1st March 20x8 to 31st December 20x8, which means that any interest which is earned or which is being incurred can be recognized only in this period. Any interest which is earned or incurred before or after this period, that has to be recorded in P&L. Okay. Now, 18 million 5% loan was received on 1st Jan 20x8. Out of that, 6 million was invested until 31st May. Now, interest payable. See, interest payable for the whole year. For the whole year would be 18 million, or let us do it like this. Our construction period is 1st March to 31st December 20x8, which is 10 months. All right. So interest payable for those 10 months or for the construction period, I'm writing construction period as CP in this just to make it short, would be 18 million 18 million into 5% multiplied by 10 months, which is 10 by 12. So this comes to 750. That is, I'm recording it in thousands, right? 750. Now, this is for the construction period, that is for 10 months. For the remaining months, interest payable for remaining 2 months would be so what I did here so far is that 18 million, Wilson received an 18 million 5% loan on 1st Jan 20x8. Now, the interest for the full year, that is for 12 months, would be 18 million into 5%. But the construction period is for 10 months, and the remaining 2 months are not the construction period. And we studied that only the borrowing costs incurred in the construction period can be capitalized, which means that only interest for 10 months can be capitalized. So we calculated interest for 10 months, which came to 750. This can be capitalized, and the remaining interest will have to be expensed in P&L. Okay, so 750 would be capitalized and 150 would be expensed in P&L. Now, this is interest payable. Now, from this 18 million, 6 million was invested until 31st May 20x8. So, investment period is from 1st Jan to 31st May. So this comes to Jan, Feb, March, April, May, 5 months. Alright, so for 5 months, it was the 6 million was invested, but our construction started from March and this was invested until May. So for Jan and Feb, for the months of Jan and Feb, the interest income which would be received from the investment would be recorded in P&L for the months of Jan and Feb. And for months of March, April and May, because from then the construction period started from March 1st. For March, April and May, that would be capitalized, or that would be set off against this 750. So interest received during construction period. So out of this 5 months, 3 months are construction period, that is March, April and May. So it would be 6 million into 2% into 3 by 12 comes to 30. So interest received for remaining 2 months would be alright. Oh wait, let me frame it like this. So interest payable for construction period 10 months. So interest payable for non-construction period. This will be easier to understand. Non-construction period, that is the remaining 2 months. Similarly, interest received for non-construction period. Okay. Now, in this, um, 30 would be capitalized and 20 would be recorded in P&L. Now, our net interest to be capitalized would be interest payable minus interest received, which is 750 minus 30. This would be 720. So that's how this question has been done. So first we noted what exactly is the construction period. The construction period is for 10 months starting from March till December. Now 18 million was received for the full year. Now the 18 million was for full 18 million and 5% was received for the full year. We segregated that in two parts. That is the interest which is payable in the construction period and which is in the non-construction period. So in construction period, it is 18 million into 5% for 10 months, because 10 months is a construction period, which comes to 750. And for the non-construction period, it would be for the remaining 2 months, which is 150. So 750 would be capitalized and 150 would be recorded in P&L. Similarly, certain part of it was invested. So we would again calculate the interest received in construction period and non-construction period. The interest received in construction period amounted to 30, that is being capitalized, and 20 would be recorded in P&L. So the net interest to be capitalized would be interest payable during construction period minus interest received during construction period, which comes to 750 minus 30, 720. This was about this question. Now, sometimes, for example, in this scenario, just one loan was taken. But sometimes, if multiple loans are taken, we would take the weighted average. When funds for the project are taken from general borrowings, the weighted average cost of general borrowings is taken. If an entity had 10 million 6% loan and 2 million 8% loan, the weighted average cost of the borrowing would be 10 million into 6% plus 2 million into 8% divided by the total principal amount, which is 12 million. So this comes to 6.33. Now the amount capitalized would be the amount spent on the asset multiplied by 6.33% per annum. Alright, so just keep in mind, if there are multiple borrowings, then we would take the weighted average, and the amount which would be capitalized is this percentage that we calculated from the weighted average method multiplied by the amount spent on the asset. Now, cessation of capitalization, that is, when would the capitalization stop? Capitalization of borrowing costs should cease when either substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete, construction is suspended, that is due to industrial disputes. So, as we saw here, that commencement of capitalization will begin when the activities have started to bring the asset for its intended use. So when substantially those activities have been completed, they are not telling that it should be completed 100%. But when a substantial amount has been completed, the capitalization of borrowing costs should stop. That is one scenario. Or if the construction is suspended due to any reason, that time the capitalization should stop. Let's solve this example. So, on 1st Jan 20x5, Syensqo began to construct a supermarket which had an estimated useful life of 40 years. It purchased the site for 25 million. The construction of the building was 9 million and the furniture and fitting cost was 6 million. The construction of the supermarket was completed on 30 September 20x5 and it was brought into use on 1st Jan 20x6. Syensqo borrowed 40 million on 1st Jan 20x5 in order to finance the project. The loan carried interest at 10% per annum. It was repaid on 30 June 20x6. Calculate the total amount to be included at cost in property, plant and equipment in respect of the development at 31st December 20x5. Now, there are many dates and values given here. So remember that firstly let's note down what is our construction period. So a construction period is from 1st Jan to 30 September 20x5. This comes to Jan to September is 9 months. Alright. So the construction was completed on 30 September and it was brought into use on 1st Jan. Remember that for borrowing costs, you have to only record the borrowing costs during the construction period. Even if the asset was being used on 1st Jan, the construction was completed on 30th September. So our time frame to record the borrowing costs, it's only for those 9 months from Jan to September, because at the end of September the construction was completed. And as it is told here that when substantially all the activities are completed, you have to stop capitalizing the cost. So you can capitalize the borrowing cost only for those 9 months. So this 1st Jan date is just given to trick. It is not relevant for this question. The question says that calculate the total amount to be included at cost in PPE in respect of development at 31st December 20x5. So as we had studied very at the start of the chapter, what all are included in the initial measurement of the cost. So that includes the site cost of 25 million. Okay, the site cost of 25 million. Then it would include the furnitures and fittings cost, because this is also required to bring that asset in working condition or to get the asset available for use. So fixtures cost of 6 million, and then borrowing costs. Borrowing costs would be, so San Cisco borrowed 40 million on 1st Jan in order to finance the project, and the interest rate is 10%. It would be 40 million multiplied by 10% multiplied by 9 by 12, because we are only concerned for those 9 months. This would come to 25, 6, 3,000. Okay. Oh, I forgot this. Construction of the building cost 9 million. So construction costs of 9 million will also be included. So total cost would be 43 million. Okay. So this was pretty straightforward.